All right, let's get right into it. We're facing a huge puzzle that every investor is trying to solve in 2026. The US job market, it's sending some seriously mixed signals. So, what does a slowing, uneven, and, let's be honest, confusing labor market actually mean for your stock portfolio? Well, let's get you the playbook. It's one of the oldest questions in investing, and right now, it might just be the most important one. It feels totally backwards, doesn't it? But the answer, well, it's a lot more complex and a lot more crucial than you might think. Let's break this down. And here it is, the bad news right up front. The latest official jobs report for February 2026, it showed a drop of 92,000 jobs. A number like that, it definitely gets your attention. It sure sounds like the economy is slamming on the brakes. But then you see this. Weekly jobless claims are still hanging out at a pretty low 213,000. And this tells you something really important. Yeah, hiring is slowed down, but companies aren't in a panic. They're not rushing to lay people off in huge numbers. So it's a slowdown, not a nosedive. So that's the key phrase right there. Cooling, not crashing. And over the next few minutes, what we're going to do is decode exactly what that signal means. And more importantly, how you can turn this messy economic picture into a clear, actionable strategy for your money. So first things first, let's see how the experts are reading the tea leaves here. We're going to dive into what some of the biggest names on Wall Street are thinking to really get the nuance behind those big headline numbers. And this phrase pretty much sums up the entire vibe. Slower, narrower, more uneven hiring. This isn't a story about some big recessionary collapse. Nope. This is a story about an economy that's getting way more selective and, frankly, a lot more unequal. So if you dig into the specifics, Goldman Sachs and JP Morgan, they're pretty much on the same page. They see unemployment settling in around 4.5% with some kind of weak job gains. But Bank of America, they add a really critical piece to the puzzle. They're calling it a K-shaped market. Well, what does that mean? It means the economy is splitting in two. One part is rising while the other is falling. This creates bigger wage gaps and puts a real strain on younger workers, especially Gen Z. So, what do we take away from all this? Really three main things. First, hiring is weak, no doubt, but we're not expecting waves of mass layoffs. Second, the job market is getting more polarized. Things like AI and those wage gaps are creating clear winners and losers. And third, you have got to look past that single headline number now. What's happening in specific sectors, that's what really matters. Okay, so you might be thinking, all right, a cooling market, that means the Federal Reserve can cut interest rates, so I should just buy stocks, right? And look, you're not wrong for thinking that, but there is a major plot twist that we really need to talk about. This is that classic bad news is good news idea you hear about all the time. The market sees a weak jobs number and immediately starts dreaming about the Fed stepping in with rate cuts to juice the economy. And that's usually fantastic for stocks. I mean, this is the simple, bullish path everybody hopes for, right? Weak jobs reports cool off wage growth, which gives the Fed the green light to cut rates, which then pushes stock prices up. It's a beautiful, straightforward story. But here in 2026, it's just not that simple. There is a catch, and believe me, it is a big one. See, the Fed's hands are kind of tied right now. Inflation is just annoyingly persistent. It's sticky. On top of that, you've got rising oil prices and a geopolitical scene that is, well, anything but stable. All of these things make it so much harder for the Fed to just go ahead and cut rates, even if the job market is getting weaker. And the risk here is very, very real. I mean, just listen to this warning from Goldman Sachs. It makes it crystal clear. A severe shock to the oil supply could totally blow up the whole soft landing story and just hammer the stock market. This isn't some far-off what if. It's a central risk for 2026. Okay, so with this whole complicated picture of a cooling labor market fighting against stubborn inflation, how in the world do you actually position your portfolio? Let's get into the actual strategy. This right here is the playbook. On one side, you have companies that are just built better for this kind of environment. We're talking big, high-quality companies with solid pricing power, the companies that are really benefiting from the AI productivity boom, and good old defensive sectors. Now, on the other side, that's where you find the more vulnerable areas. Cyclical companies that need people to be out there spending a ton of money, smaller firms that desperately need cheap credit to grow, and those really expensive growth stocks that get crushed if inflation stays high and the Fed can't cut rates. But, and this is the crucial fine print, this whole strategy works only as long as the labor market is just cooling off, not collapsing. The moment that weakness starts to seriously chew into company profits, then even the safer stocks are going to be in trouble. And here's what's actually at stake. Goldman Sachs thinks that even a moderate shock, say from higher oil prices, could yank the S&P 500 down quite a bit. A severe shock, much, much worse. This just goes to show you the kind of volatility we could be facing. So let's pull all of this together. What is the final verdict? What's the bottom line for you as an investor trying to navigate this whole thing? Honestly, it really is like walking a tightrope. This is the bet. This is the one bet the entire market is making right now. It's a bet that the economy can walk this impossibly narrow path, that the job market cools off just enough to let the Fed cut rates, but not so much that it sends us into a recession and absolutely crushes company earnings. It is an incredibly delicate balance. So here are your key takeaways for 2026. Number 1, the labor market is cooling, not crashing. Remember that. 2, this is only a good thing for stocks if inflation also cools down. 3, your playbook should be all about focusing on quality and resilience, not just chasing growth. And 4, pay very, very close attention to those monthly jobs reports. They matter more this year than they have in a long, long time. And that leaves us with this one final thought. The market is basically doing a high wire act, balancing between a perfect soft landing and a painful recession. The real question is, have you built a portfolio that can act as your safety net no matter which way it falls?